Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Payback Period Explained, a guide to understanding and calculating it easily. Advantages of using Payback Period. The payback period isn't just a basic financial tool, it's a practical way to evaluate investments quickly. Its simplicity and focus on recovery time make it a favorite for businesses and individuals alike. Here's why it's so widely used. Simplicity and ease of use. Many financial models are complicated, but not the payback period. It's straightforward and doesn't require advanced math or software. Quick to calculate. With just basic numbers, initial investment, and yearly cash inflows, you can figure it out. Accessible to anyone. Even small businesses or individuals with limited financial knowledge can apply it. Efficient for comparisons. Evaluating multiple projects? The shortest payback period stands out immediately. Think of it like deciding which line to stand in at a store checkout. You naturally pick the one that moves the fastest. The payback period works similarly, it highlights the option that gets your money back the quickest. Best of all, it's often the first step, cutting down analysis time when speed matters most. Risk assessment. Every investment involves risk, but the payback period helps you measure how much and how fast. Quicker recovery equals lower risk. The faster you earn back your money, the less time your investment is exposed to uncertainties like market volatility or unexpected expenses. Great for high-risk industries. If you're in tech or startups, where timelines are short and risks are high, this method keeps you cautious. Helps set benchmarks. Businesses often use payback periods to define acceptable risk levels. If a project takes too long, it's a red flag. Imagine lending money to a friend. The one who pays you back in a week feels like a safer bet than the one asking for 2 years. Investments are no different. Shorter payback times feel more secure, especially in unpredictable environments. In short, the payback period simplifies decision-making and provides a solid starting point for managing investment risk. While it's not perfect in capturing long-term gains or costs, its practicality and focus on the near term make it an essential tool in financial planning. Limitation of payback period. While the payback period is an easy-to-use tool, it's far from flawless. It simplifies investment analysis but misses some key details, which can lead to poor decisions if used alone. Below, we'll explore its major limitations to help you understand where it falls short. Ignores cash flows after payback. The most glaring issue? It stops counting cash flows the moment the initial investment is recovered. That means it overlooks long-term profits, which are often the most significant part of a project's value. Let's break it down. Imagine 2 projects. Project A pays back in 3 years, with limited cash flow afterward. Project B takes 5 years to pay back but generates massive returns for 10 more years. If you only use the payback period, Project A would always win, even though Project B is much more profitable in the long run. This narrow focus can steer businesses away from smart, profitable investments. Think of it like focusing only on the first 10 minutes of a movie. Sure, it sets the stage, but you'd miss the plot twists, character growth, and climax. The same happens here. Valuable post-payback cash flow gets ignored. Does not consider time value of money, in simple method. In its simplest form, the payback period doesn't account for the time value of money. What's that? It's the concept that $1 today is worth more than $1 tomorrow. Inflation, opportunity costs, and risk all reduce the future value of money. Here's why this matters. If you were promised $1,000 today or $1,000 5 years from now, which would you take? Most likely, today's money. It has more value due to its immediate usability. The simple payback method treats all cash flows as equal, whether they occur in year 1 or year 10. That's unrealistic and can distort the true financial impact of a project. For example, suppose you invest $20,000 in a project that's expected to generate $5,000 annually for 4 years. Under the simple method, the payback period is exactly 4 years. But in reality, when you factor in the time value of money, the payback period would be longer because each year's cash inflow carries less real value over time. The result? Simple payback can make investments seem better than they really are, especially in long-term projects or those with uneven cash flows. Without discounting future inflows, it's like comparing apples to oranges. It just doesn't reflect the true picture. These limitations don't mean the payback period is useless, but they do highlight the importance of using it alongside other financial metrics. By itself, it tells only part of the story. Comparing payback period with other investment metrics. The payback period is a solid starting point for measuring investment recovery time, but it doesn't tell the full story. To get a clearer perspective on a project's value, it's helpful to compare it with other metrics like net present value, NPV, and internal rate of return, IRR. Each metric brings unique insights to the table, offering a more comprehensive financial analysis. Net present value, NPV. Discuss how NPV differs from payback period and its advantages. Net present value adjusts future cash flows to their current value using a discount rate. This ensures the time value of money is factored into the decision. Unlike the payback period, which focuses only on how quickly funds are recovered, NPV looks at overall profitability in today's dollars. Key differences between NPV and payback period. Time value of money. NPV accounts for it, the simple payback method does not. Long-term focus. While payback stops after recovery, NPV considers all future cash flows. Profitability insight. Payback measures recovery speed, but NPV shows net gains or losses. Let's say you're deciding between two projects. Both have the same payback period of 3 years, but Project A's NPV is $5,000 while Project B's is $10,000. In this case, Project B generates more value even though both recover money at the same speed. Advantages of NPV. Provides a clear measure of a project's total profitability. Accounts for inflation, opportunity costs, and the risk of future cash flows. Makes comparing projects with different cash flow patterns more accurate. However, NPV has its own challenges. It requires picking a discount rate, which can be subjective. Still, it's one of the most trusted tools for long-term investment analysis. Internal rate of return, IRR. Explain the differences and when to use IRR versus payback period. The internal rate of return estimates the profitability of an investment by calculating the discount rate that makes NPV equal to 0. In simpler terms, it's the break-even rate of return for a project. IRR and the payback period are different in both focus and application. Key differences between IRR and payback period. Focus on returns. IRR measures the percentage return, while payback measures time to recover costs. Whole picture. IRR evaluates all cash flows over the project's life, unlike payback's limited scope. Complexity. Payback is simpler and quicker to calculate, while IRR involves more math. Imagine choosing between two projects. Project X has a payback period of 4 years and an IRR of 12%. Project Y has a payback period of 5 years but an IRR of 18%. While Project X recovers money sooner, Project Y delivers better returns over time, making it more attractive for long-term gains. When to use IRR. Ideal for projects where percentage return matters most, e.g., comparing investments with different capital requirements. Useful when long-term profitability is more important than short-term risk. IRR shines in cases where businesses prioritize maximizing returns. However, it can be misleading for projects with uneven cash flows or non-standard timelines, so combining it with NPV or payback period works best. By comparing metrics like NPV and IRR with the payback period, you can better gauge both the short-term and long-term value of investments. Each has strengths, but together they provide a fuller picture for making informed financial decisions. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.